Ready to redefine your investment game.
We have a president here who went to a picket line while the U.S. bond market was cratering. And that's what I think the rubber meets the road here. I think the most salient thing you have to think about now as an investor is what's happening with U.S. bond yields. We have a condition now where the faith in the world's reserve currency and our sovereign debt is fracturing, eroding, and cratering right before our eyes. Well, I will short the bond market when I have to. What I did, first of all, is on August 1st, I sold all of my long duration bond exposure. We have no long duration bond exposure at all. We're all in T-bills here, Pinto, and very, very short term U.S. government debt. That's the first thing you should have done. And let me explain to you what the process is, what the problem is that we're seeing here. So first of all, disinflation, which I called for to occur in 2023, which we did indeed have, where inflation went from 9%, CPI inflation went from 9% to 3%, is now coming to something called reflation. So 3% to 3.7% on the headline figure. So we no longer have a condition where inflation is the second derivative is falling. We just have a rate of change increase in inflation and increasing at a faster rate. So that's number one. Number two, if you listen to the Atlanta Fed, sometimes I do, sometimes I don't. I mean, they pulling this 5%, 4.9% to be exact, headline figure for Q3 GDP. That's an acceleration in GDP. So you no longer have falling GDP. You no longer have disinflation. Those were things that would make you want to buy the long end of the bond market. Gets a lot worse, Kerry. China has been a seller of our treasuries. Their reserves are parked in U.S. dollars, and those dollars are parked in U.S. treasuries. When you want to get out of U.S. treasuries because you might be wanting to, invade Taiwan, okay, you sell your treasuries. You no longer want to be a victim of U.S. dollar hegemony. Sell dollars, buy back your currency, get out of the U.S. dollar grip, the grip of the U.S. dollar and the U.S. government. Gets worse. Japan, they have two things that they're doing. One is they're selling U.S. treasuries for the very same reasons, not Taiwan, but they just don't want to be exposed to U.S. dollar hegemony. But they have to sell their currency reserves because their yen is crashing. It took 150 yen to buy $1 this morning. I mean, their currency is absolutely crashing because they have this asinine yield curve control. Governor Ueda over there in Japan saying, inflation is not sustainably at our target level. It's been above their target for months on end, way above their target. But he just lies and he says, I don't believe it'll be able to stay there. So we're going to cap yields at 0.7%. It was capped at 0.25%. I don't know. Can I just finish this? This is very important. So now you have those conditions of higher inflation. You have GDP at 5%, according to the Atlanta Fed. You've got Japan selling. You got China selling for Japan selling for two reasons. Then you have this massive issuance and supply. We are running $2 trillion annual deficits in peacetime and when growth is accelerating. This is incredible to me, the amount of supply that the U.S. is dumping on the market is rising very quickly. Who's going to buy it? The Federal Reserve was buying $85 billion a month of U.S. debt, QE, and they falsified the entire Treasury market. I mean, they monetized $4 trillion of debt since COVID broke out. So we had no market for Treasuries. Now the Fed is selling their balance sheet, adding to the supply from China and Japan, people that have, boycotted U.S. debt. And they're selling 85 billion a month in U.S. debt. So this is what is we're now discovered. This is called price discovery. Oh, let's have a real market. Let's fight inflation. Well, great. I laud you. Compliments to you for trying to go down that road. But when interest rates were falsified for so long, near 0% for most of the last 14 years, borrowing costs were free and debt levels ballooned and asset prices went to the moon. When you when you try to return to a normal market, chaos breaks out. You saw that in March when the Fed had to rescue the entire U.S. banking system. And you're seeing it today as the bond market fractures and implodes and Joe Biden's walking the picket line. The fact is that there's a $1.8 trillion refinancing wall coming very soon in the corporate bond market in 2024 and 2025. We have to start rolling over this debt. And it's going to be rolled over at much higher interest rates. So and here's the other side of that. There's three sides to that coin. So there is a maturity wall coming. So you say to me, the perma bull say, well, the consumer has termed out its debt. It borrowed money to buy a house at 3%, and they're good. Good. And then I say to you, well, then what you're saying to me is that nobody has to buy a house. No one has to move because they don't want to change their mortgage from a 3% loan to an 8% loan. We're almost at 8% now in mortgage rate. And then I'm going to say to you, then doesn't that mean ipso facto that the Archie Bunker used to say that, by the way. Well, doesn't that mean that the economy really stinks if no one could afford to buy a house and no one could afford a new car loan? It will go down significantly. But when? It's all about timing. I'm long the US dollar against the euro and the yen, not against hard assets. I actually have a 5%. Right. I have a 5% now position in physical gold. No, I haven't had any miners. I actually sold some of my physical gold a little bit ago because one thing gold market does not like is rising nominal rates and rising real rates. And we have that right now. So, but that's going to change quickly because we just talked about that maturity wall. I don't know the exact date, but I will know when real interest rates start to fall, you could just back up the truck on physical gold and the miners, but not until then. You got to get, that's why, philosophical investing and stop clock investing doesn't really work. This year will mark the third year that U.S. debt, U.S. Treasury bonds have been in a bear market. And that has never happened before. Do you know if you said to yourself, I'm close to retirement. I want to have a 60-40 portfolio, but I want to have 60% bonds and 40% equities, not just 60% equities, 40% bonds. I want to overweight bonds. Those bonds are down 50% in the last 2 years. Half of your money. Now you could hold that 30-year bond till maturity and you'll break even. You're holding your 30-year bond that's yielding 1%. Inflation will not be 1% for 30 years. And active money managers who have a brain are becoming popular too. Because you just can't sit here and say, it's 1960 or it's 60-40 portfolio is wonderful. Everything always comes back, blah, blah. You're going to have volatility. You've had and are going to have with increased intensity, volatility in the bond market and in the stock market. So what sectors do you want to own in the stock market? Where do you want to invest along the yield curve? Do you want to own high yield or do you want to own T-bills? You have to know the right answer. Otherwise, you're going to get wiped out.
As we conclude